Okay, so we're on to our last section C question in this mock. Once again, 20 marks available here, so we've got 36 minutes we'd allocate. For 4 marks, we need to calculate the standard contribution per pair for each of the 3 sizes of work shoe. And then for each size of shoe, we need to calculate these 3 variances: sales price, sales mix, and sales quantity. 3 marks each, so we'd assume just by glancing across the left, there's 3 sizes, so there's probably 1 mark for each variance for each size. Variance calculations like this, if you can get your head around them through building up a good technique and practice, really easy marks to get for mix and quantity variances, because once you've got the system in place, you just need to put the figures in and get the answer, whereas a lot of people just can't get it in their head of how to do variances, and so they would maybe miss out on a lot of those 9 marks. And then 6 marks, comment on the possible reasons for each type of variance. Well, there are 3 types of variances for 6 marks, so we can probably estimate 2 for each. And then briefly discuss whether consideration of learning curve effect is still relevant when standards set in the next quarter, if their plan is to replace all the skilled labourers with computer-aided manufacturing technology in the making of shoes, and that's 1 mark. Let's take a look at the scenario we're given. Healthy Feet Co. is a family-owned shoe manufacturing business that's well known for its handmade work shoes, which they claim to be safer and more comfortable compared to other work shoes in the market. Given the labour-intensive manufacturing environment, it's common to expect some learning curve effects whenever HF is launching a new design of work shoe. They're planning to roll out a newly designed shoe called Comfort in 3 different sizes, small, medium, large, in the next quarter. The following information has been extracted from the standard cost card. For each size, we've got the selling price, the direct material costs, the variable conversion cost per pair, and fixed overheads allocated per pair. And remember, the first question was asking us about the standard contribution. On the variable conversion costs, it tells us it's $50 per hour multiplied by the standard labour hours per pair, but as it's likely that an estimated learning curve will appear alongside the production, management accounting has agreed to a standard learning rate of 75%, with the estimated time spent in making the first pair of shoes being 3 hours. An estimate of the labour hours based on this information is given below. So we've got 3 levels of output, 4, 5 and 6 pairs, the cumulative hours, and then the cumulative average hours per pair. And you see, this is just to demonstrate the calculation. The cumulative hours divided by the cumulative output gives the average, and I've shown that on the calculator over here. The standard labour hours per pair has been agreed as the time spent in producing the 5th pair. At the end of the quarter, cost and sales information for all 3 sizes of the work shoe are as follows. We've got the actual variable cost, the actual sales in pairs, and the budgeted sales, and they adopt marginal costing for output valuation. When we're calculating sales variances, as we're doing in part B, because it's using a marginal costing system, we use the standard contribution as opposed to absorption costing, where we would use the profit. But there's probably a clue because we're asked to calculate the standard contribution per pair. So let's go ahead and answer part A, calculating the standard contribution per pair for each of the 3 sizes. So we've got our 3 sizes, small, medium, large. I'm always a fan of using shorthand or abbreviated terminology in a spreadsheet, as long as it's clear what we're talking about. There's no point writing extremely long row titles here. So for small, the selling price is 162, 165, and then 180. And then direct materials, I'm going to take from the table here. I'm going to use a negative figure because then I can use my sum function. And then the conversion cost per pair, that's going to be a side working. And so the contribution is going to be the sum of the 3 above. Just for completion, I'll put dollars up the top. So this is probably how the marks are allocated. There's probably a mark for this side working, and then 1 mark for each of the columns I've done here. We want to use the time taken in producing the 5th pair in calculating our conversion cost, and it's told us here the time taken for the 4th, 5th and 6th. So if we take the cumulative for the 5th and the cumulative for the 4th, the difference will be the time taken for the 5th. So that's 7.7 and that's 6.76, and so the difference is the time taken for the 5th pair. But we're not there yet. This is in hours. The conversion cost will need to be in dollars, and we need to multiply that by 50. So the conversion cost is 50 multiplied by 94, so that's 47. I always inform my students not to just put numbers that appear from nowhere in the cell, but because the 50 is there, I'm comfortable doing that. But if you've got a number from a calculation, it's better to use the circular reference in, and then the examiner can click on your cell and see where it's come from. If you wanted to do a little bit more, you could add in a little label like that. So this equals minus the figure there, and they're all the same. So that's part A done. I like to highlight my answers. The only thing I would probably change, although it doesn't tell us how many decimal places, I think I would prefer if it was in 2 decimal places. Although it's made no difference, I think it's probably more accurate just in case there are some cents involved with the contribution. Now we're going to move on to the variance question, but we won't be able to reference this spreadsheet, so we're going to have to bring some data across, and I don't want to make a mistake. So I've just put the contribution figures in the scratch pad so I don't risk making a mistake as I bring them across. So part B1, we need to calculate the sales price variance. The sales price variance and the sales volume variance make up the total sales variance. And the sales volume variance can be split into mix and quantity variances. And the sales price variance compares the actual price that we charged compared to the standard price for the actual quantity. So there are 2 ways to do it. I'm only writing this out for the benefit of the video. These are saying the same thing. We either find the difference between the actual price and the standard price, we multiply that difference by the actual quantity, or we multiply the actual price by the actual quantity, and then we multiply the standard price by the actual quantity, and we find the difference. And the approach I would choose would be driven by the way the information's been given to me. In this row here, we're given the actual sales. So for example, for the actual quantity sold at the actual price sold for small is 18,745. So that's given us this whole term here, actual quantity multiplied by actual price. So therefore, I'm going to use the bottom one, use the figure as it's given me there, and take away the standard price by the actual quantity. If you struggle with variances, it's absolutely fine to write it out like that, just so you know that you're picking up the right figures. If you're more comfortable, you'll probably use some sort of shorthand. So this column I'm just copying straight across from what I've been given in the bottom table in the row that I've just looked at, the actual sales. And now I need the standard price by the actual quantity. So for small, the standard price is 162 and the actual quantity is 115. For medium, it's 165 multiplied by the 75. And then for large, it's 180 multiplied by 110. So we've calculated our 3 variances. Some people try to remember which one's favourable, which one's adverse. I always like to work it out. If what happens actually is greater than standard, and we're talking about sell-in, that will increase our bottom line. So that top one is a favourable. And then because we've used the same process, we can then assume that the sign here makes that one adverse. So that's the answer for the sales price variance for each of the 3 sizes. It doesn't ask us to do a total, but there's certainly no harm in just summing those up to show the overall. And now we'll move on to the sales mix variance. I'm just going to copy the first bit of my table down here so I don't have to rewrite that out. Now the way I like to do mix and yield or mix and quantity variances is I use these 3 headings: the actual quantity at the actual ratio, the actual quantity at the standard ratio, and the standard quantity at the standard ratio. The difference between these gives me my mix variance, and the difference between these will give my quantity or my yield type variance. Others use different terminology. They might say actual quantity and actual mix. I prefer ratio because it then reminds us we're looking at the ratio between the 3 products that they're selling. So the actual quantity at the actual ratio, instead of working in dollars as we were above, we will be working in shoes. When we get to the variance, it has to be in dollars, but we need to make sure we know what units we're working in. And by writing it here, it's a reminder. And at some point, we'll multiply by the contribution, and then that will turn it into a dollar amount. And then we've got our variance. So in terms of shoes, we just can get this from the table here. This is the actual shoes sold in the actual ratio. So effectively, this is what actually happened. So we sold 115 small, 75 medium and 110 large. And what we need to now do is take that volume that we've sold and then establish what the amount would be for each line if we kept to the standard ratio, i.e. what we expected from the budget. So the way we do that is we sum those up, and that gives us the figure at the bottom, and then that figure gets carried across here because we're now going to share this 300 out based on the ratio that we expected in our budgeted sales, which is this ratio here. You might want to do a side working, or you might be happy to just do it into the spreadsheet here. But what we're saying is normally for small, we'd expect out of this volume of sales, which is 250, 60 would be small. So 60 250ths would be small. So we take 60 250ths of the 300, and that's what ends up sitting in this cell here. And for medium, we'd expect 100 out of every 250 to be medium. So 100 out of 250 multiplied by that bottom one. And here you can either do a balancing calculation, or we can just do the same approach that we've done there. So 90 out of every 250 we'd expect to be large. So what we've done is taken the actual amount of each sold and then re-established how many of each we would expect to sell had they been sold in the expected ratio. And that's because it's a mixed variance. So we're looking at the impact of the standard ratio compared to the actual ratio. And then we calculate the difference, which is a simple subtraction. So we're still working in shoes. We now need to convert it into a dollar amount. And so our standard contribution comes into play. And this is what I did before. I took the standard contribution calculated from the previous sheet, and that way I haven't had to try and remember it, and I'm not flicking back and forth. So the sales mix variance is now, we just multiply the difference in shoes by the standard contribution. And then once again, I need to decide, is each of these favorable or adverse? If this is actual and this is actual standard, where this is greater than this, because this is all actual, that means we did better because we're looking at sales. So that's a favorable. The negative one must be adverse. That's favorable. So the overall must be favorable. So that's part 2 done there. Don't forget to put the F's and the A's in. A lot of students forget those. And then we can often get more efficient. I like to copy it, but just remember, I've got to change a lot of this in order to get the calculation correct. But as soon as I change this, it's going to change this. And I want this one over here to be standard quantity, standard ratio. So what I'm going to do is use the reference in here. Although I haven't changed the numbers, if I change one of these, that would change the total, which circles back to what I had up here. I'll show you by example. If that was 90, you see everything changes. So I've locked in this column, and now I need the standard quantity at the standard ratio. Where do I get that from? I just read that straight off the bottom here. So 60, 100 and 90. With a mixed variance, these should be the same. There's no expectation that these would be the same in a quantity variance because we expect that we're selling a different amount to the budget. So our difference is calculated by itself. The standard contribution stays the same. So hopefully you'll see this was a very efficient way to get here. What I do need to do is make sure I get my favorables and adverses correct. As a clue, as a hint, with a quantity variance, these should all be the same. They're either all favorable or all adverse. So here, the actuals are always greater than the standards. The actuals on the right, always greater than standards. So if we actually always did more than we'd expected, and it's for sales, then they're all favorable. And that's my 9 marks for the variance calculation. The only thing I need to change is I've got my heading wrong here. That's the sales quantity variance. So next we need to comment on the possible reasons for each type of variance in B1, B2 and B3. There's 6 marks. It's a shame the question doesn't come across because we might need to flick back and forth a bit. The 3 obvious headings are the three variances. The approach I would take here is what I want to do is demonstrate to the marker that I understand firstly what each of these variances is. So I'm going to open with a definition for each, and I think that will score my first mark, 1 mark under each. So that's half of the 6 marks that are on offer. But I'm not just going to come up with a textbook definition like I did on the other section C question earlier. I'm going to tie it in with some of the narrative that's here. So I'm not going to talk about price in isolation. I will be talking about price in relation to the shoes that are being sold. And then the way I would aim to pick up my second mark is I will give a reason why that variance has occurred. And my preferred choice for saying why is if there is any information they've given me here, then I will use that. If there isn't information they've given me here, then I will use some idea that I can work up in my head while I'm answering this question as to why that variance could have occurred within a company that does what this company does. So to say that again, I'm going to use an appropriate definition for each of these variances, linking it back to the narrative, and then I'm going to see if I can say why that variance could have occurred, ideally referencing something here. If not, then referencing something that could reasonably occur in a company that makes shoes in the way that Healthy Feet does. For the sales price variance, I've just given a summary of what I did in the calculations in the previous page, and then I've said the favourable variance reflects that the price actually charged was greater than the standard. And given that these are handmade shoes, perhaps there's less supply in the market, meaning that HFCO could increase its prices for these sizes. Conversely, for M, the medium, maybe there's more competition, which meant that actual sales were lower and a lower price had to be offered to compete. And the reason I can say that is it's got my actual sales here, and they'd expect to sell more than they did for this one, but they sold less compared to the others, even though they would normally expect to sell more. If, however, this had been different, had the actual sales been a higher volume, I might have suggested something like maybe there was a bulk purchase and they offered a discount. So I'm using the data to drive the narrative that I offer. Now we'll look at the sales mix variance. So once again, I've tried to offer some information to the marker to let them know that I understand what a sales mix variance is. A sales mix variance will always have some shoes as adverse and some as favourable. And that has to be the case because the total number sold in our comparison, if we go back to this, is always the same. So if one of these is higher in actuals than in standard, then somewhere else there must be offset and another one must be lower. So a sales mix variance will always have some shoes as adverse and some as favourable. The overall favourable sales mix variance of $106 is because a higher proportion of S and L was sold than the standard, and these have a higher contribution per unit than M. But likewise, down here I can see that S and L were sold much higher levels than budgeted. Both S and L sold larger volumes than budgeted, and perhaps the sales team were promoting these sizes more. And sales quantity variance, a favourable sales quantity variance of 1854 reflects that a greater volume of sales was achieved overall than expected. It could be that the benefits of these shoes being safer and more comfortable combined with HFCO's reputation means that budgeted demand was underestimated. I hope you can see that I've pulled in information from what I'm given here. I might have gone a bit far with this, maybe this is more than we need for 6 marks, but I've added this in. Alternatively, it could be that as these are a new product, as it says up here, there was a honeymoon period of demand on launch which will now level off. And that does happen. New products, there's a lot of initial excitement, and so maybe the budgeted sales figures are more accurate if we were looking over a longer period, but they've benefited in this initial quarter because they're new. We're almost there now. Just need to briefly discuss, this is for 1 mark, whether consideration of the learning curve effect is still relevant when standards setting in the next quarter if they're planning to replace all the skilled labourers with computer-aided manufacturing technology in the making of shoes. So 1 mark answer, given that the learning curve effect occurs when there's a highly repetitive and labour-intensive process, removing this with computer-aided technology means the effect will be minimal or not present at all. And what that question was trying to do was make sure we understood these criteria. Highly repetitive, labour-intensive process is what's required for the learning effect, along with a workforce that are prepared to learn and improve and a stable workforce. And that's an example of where they look through some important things in the syllabus and they craft a question which effectively is trying to get you to demonstrate that you remember those bits of technical knowledge. So there we go. We've now finished all questions on this exam. We haven't got any flagged. If we did have some time left and there were any flagged, obviously now would be the time to go back to them. What you could do now, if you did have some spare time, very unlikely, most people run out of time before they get to the end, is you could maybe go back and check some of the calculations. Certainly don't stop early. And then the other thing you could do is you could come back to your section C, and this one we felt okay with, but you remember I thought I probably was 1 mark or maybe 2 marks short on this one. So a good opportunity now to go and try and capture one or more of those missing marks. So I wish you luck when you sit the exam in a few weeks' time. All the best.